Stocks are near highs. Gold is breaking records. Silver is surging with volatility. So in 2026, which one actually protects your money? Because when uncertainty rises, investors run to hedges. But here's the uncomfortable truth. Not all hedges work the same, and not all risks are equal. Today, we're breaking down stocks versus precious metals, which is the better hedge in 2026, and more importantly, hedge against what? Let's get into it. Before choosing a hedge, you need to define what you're hedging against. In 2026, investors are worried about inflation returning, a potential recession, currency weakness, geopolitical tension, market volatility, and fiscal instability. Different assets protect against different risks. And this is where most investors get it wrong. They don't clarify the threat. They just buy what's trending. Quick question. If stocks fall 20% tomorrow, does gold automatically rise? Not always. Sometimes both fall. Sometimes both rise. Context matters more than correlation charts. The case for stocks as a hedge. Let's start with stocks. It may sound strange to call stocks a hedge, but historically, equities have been one of the best long-term inflation hedges. Why? Because companies can raise prices. If inflation rises, businesses adjust pricing, revenues increase, and nominal earnings grow. Over long periods, equities tend to outpace inflation. But that's long-term. In the short term, stocks are vulnerable to rate hikes, economic slowdowns, liquidity crunches, and earnings contractions. So stocks hedge against inflation over time, but they don't hedge well against volatility or sudden shocks. The case for gold as a hedge. Gold has a very different role. Gold doesn't produce earnings. It doesn't grow revenue. It doesn't pay dividends. But it shines during currency debasement fears, real yield declines, geopolitical crises, and monetary easing cycles. Gold is less about growth. It's about confidence. When confidence in monetary systems weakens, gold often strengthens. In 2026, with fiscal deficits elevated and rate cut debates ongoing, gold's appeal as a monetary hedge is clear. But here's the nuance. Gold is a hedge against monetary instability, not necessarily economic growth. Let's challenge an assumption. If inflation spikes again, do stocks win, or does gold win? If inflation is controlled and growth continues, stocks benefit. If inflation spirals and real yields fall, gold often benefits. Same inflation, different outcomes. Silver, the volatile middle ground. Silver complicates the debate. It acts as a precious metal hedge and an industrial growth asset. That means silver can outperform gold during strong economic expansions. But it can also fall sharply during recessions. Silver isn't a pure hedge, it's a hybrid. In 2026, with industrial demand tied to electrification and technology expansion, silver's long-term thesis is compelling. But as a short-term hedge, it's volatile. Very volatile. Historical performance during crises. Let's look at patterns. During major financial stress events, gold often rises or holds value, while stocks typically decline sharply. During inflationary growth periods, stocks tend to outperform and gold may lag if real yields rise. During deflationary recessions, both stocks and metals can fall initially, but gold often recovers faster. The key takeaway, there is no universal hedge. There is only the right hedge for the right scenario. The 2026 macro environment. So what makes 2026 unique? We were dealing with elevated government debt, shifting monetary policy, persistent geopolitical fragmentation, energy transition spending, slower but not collapsing growth. This is not a classic boom. It's not a classic recession either. It's transitional. In transitional environments, diversification matters more than prediction. Imagine two investors. Investor A goes all in on gold. Investor B goes all in on stocks. If the economy stabilizes and earnings grow, Investor B likely wins. If currency confidence erodes and real yields collapse, Investor A likely wins. The smarter investor might not choose one. They might balance both. Volatility versus long-term growth stocks are engines of growth. Over decades, equities have built wealth more consistently than precious metals. Gold preserves purchasing power. Stocks compound capital. That's a fundamental difference. In 2026, if your concern is short-term instability, metals help stabilize. Long-term wealth building, stocks historically led. The time horizon changes the answer completely. The dollar factor, the US dollar, plays a critical role in this debate. If the dollar weakens significantly, gold tends to benefit. Commodities rise. Multinational stocks may benefit from translation gains. If the dollar strengthens sharply, precious metals often struggle. U.S. assets may attract capital flows. Currency cycles shape hedge effectiveness. And in 2026, currency dynamics are front and center. What institutional investors are doing, large institutions rarely choose extremes. They allocate core equity exposure for growth. a percentage to gold or commodities for risk diversification, bonds for income and capital preservation. The goal isn't to predict the next crisis, it's to survive multiple scenarios. That mindset is different from retail all-in strategies. Let's simplify this. If you had to protect against inflation spike, market crash, currency debasement, economic expansion, would you really use the same asset for all four? Probably not. And that's the key insight. So which is the better hedge in 2026? Here's the honest answer. It depends on the threat. If you fear monetary instability, gold likely outperforms. Strong nominal growth, stocks likely outperform. Short-term volatility, metals may cushion impact. Long-term wealth erosion, equities historically win. In 2026 specifically, the environment suggests uncertainty, but not systemic collapse. That makes diversification, not extremes, the rational approach. Because markets are not binary, they evolve. The real hedge is clarity. The debate between stocks and precious metals isn't about which is superior. It's about understanding their roles. Stocks create wealth, gold protects confidence, silver amplifies cycles. A hedge isn't about maximizing returns. It's about minimizing regret across scenarios. And in 2026, flexibility may be more valuable than conviction. If you found this breakdown helpful, subscribe for weekly macro insights without hype. And now I want to hear from you. If you had to choose one hedge for 2026, stocks or precious metals, which would it be? Drop your view in the comments, because the smartest investors don't just chase returns, they understand risk. And in this market, risk is everything. See you in the next video.